Test now. Yeah, if I'm going over the pretest, wouldn't you want to take notes and then go back and fill it in, right? Yeah. So let's spend some time on the pretest. The pretest is critical. It's basically you can read the book and then guess what information is important from the book to apply, or I tell you what information is important to learn from the book and learn from the resources that I provided to you, so you focus in on the things that are critical as the foundation for analysis in your investments. Okay. So I'm setting the foundation here. We haven't even gotten into application, but I got to set the foundation so that you guys are talking in my language so that we can communicate. Okay. So I need to communicate at a very high level with you so we can solve the problem. Okay. And we're going to solve some great problems in this class. So I'm not going to go over the quiz, and I'll wait to do the syllabus. Did everybody get a statistical pretest? All right. Now I had a professor at San Francisco State when I did my undergraduate degree in economics. She always gave a statistical pretest. And I thought it was brilliant, because it refreshes your mind, it allows you to focus, and then you come back and you have a good foundation. So she was amazing in providing me with that insight. And she was an amazing professor. God bless her. Law of large numbers. What's the raw material of finance? Well, statistics is actually the application to the raw material. What's actually the raw material? Data. It's data. Okay. Do you want more or less data? More. Got it. And if I standardize the data, if I standardize it, and I have a lot of it, what happens? It becomes a normal distribution. And if I get a normal distribution and the distribution is nice and tight, right, around the mean, what does that allow me to do? Exactly, I can forecast. And being able to forecast is important. If I can forecast the future, am I valuable? Absolutely. I can forecast production, I can forecast sales, I can forecast earnings, I can forecast stock prices, I can forecast returns on stock prices. And if I can forecast the direction of stock prices, can I make a lot of money? Absolutely. Not only just investing and going short, but by trading derivative contracts, off the indexes. So we're going to talk about that too. Okay. So I'm giving you in this course basically a cram course in your concentration. Okay. With a graduate level application, with a doctorate level insight. Okay. Because I see no differentiation between undergraduate and graduate students. They're the same. They're highly motivated. They're highly intelligent. They basically can operate at the same level. It's just that some professors think that undergraduate students are incapable of doing great things. I know undergraduate students can do great things as well as graduate students if you give them the opportunity and you treat them with respect. And that's what I'm trying to do. Okay. So the law of large numbers, we try to get as much data as possible. So am I better off doing annual data over a 10-year period? Or can I manufacture data by going to quarterly intervals? So I basically have 10 years of data. I can analyze it on an annual basis. How many data points do I have? 10. What if I do quarterly? 40. What if I do monthly? What if I do weekly? What if I do daily? Year over year, right? That we're talking about. Now, if I go back 5 years and I'm doing daily, year over year, I get over 1,000 data points, right? What would you rather have, 10 or 1,000? If you're doing mean variance analysis and statistical applications, do I want 1,000 data points or do I want 10? I want 1,000. Because if I have 1,000 data points and the data is normally normalized, and the sample approximates the universe's, the universe, and the sample that I'm pulling is normally distributed, I can approximate the universe through the sample by having a large data set. So in statistics, we're constantly looking at ways to basically create large data sets if we're dealing with data sets that have limited amounts of data. We can manufacture data, okay, from very small data samples. And when you go off and do your master's degree, you know, at Wharton or Harvard or wherever you're going to go, you're going to take some MBA classes. You're going to be working in doing Monte Carlo simulations, okay, where basically you're doing repeat sampling, you're grabbing the sample, you're throwing it back, you're doing it like 5,000 times. So you're basically creating huge data sets from very small data samples. Okay, so that's the key. And then you can look up, what I would do is go back after I go over this, go back and look up the definitions online and augment and add to this primer. Okay? And the best students that do the best work, this thing is like full. Okay? Because they did the research and they put it in, and they wrote it in legibly where I could actually read it, not doing 8th grade, well, if I scribble it in there, maybe you'll think I did it, and you know, that it'll look like I put a lot of work in it, and it's like, no, that doesn't cut it, okay? You need to work on your handwriting, okay? You need to work on your handwriting, right? Because you're in a meeting, you're taking notes, the boss says, hey, give me your notes because I need to type them up because I want to present it to the board in an hour from now. Oh, I'm sorry, I don't have good handwriting. What's going to happen to your career? Yeah, totally. You need to know how to write legibly. This is pretty good handwriting. Can you read that? It's not great, but can you read that? You need to work on your handwriting. And do it now, okay? Because you'll need it. Because if I'm writing the notes, I don't do a very good job of writing the notes, and I give them to you, it's like, oh, you know, type them up, and you can't read them, what's the problem? What?
Can't read them.
You can't read them. So what are you going to do? You're going to get up and go to the person's office and go, I don't understand what you wrote here. Oh, that's an S, not a 5. Okay, great. And you're going to go back, try to type them. Is that ridiculous? Yeah, it's totally ridiculous. You need to know how to write legibly. Okay? It's an extremely valuable tool. It's part of the communication process. Test question. Is there a high correlation between legible handwriting and grade point average? Do you think that the person that has really nice handwriting is also a good student? Do you think there's a correlation? Just if I took a sample and I looked at, you know, people who have really good handwriting and I checked their GPA, do you think that the people who have really nice handwriting also have high GPAs? Yeah. It's not saying that you have to be a good to be brilliant, right? But there is a high correlation between high GPAs and people who get really good grades and people who write legibly and can write. And I've seen some beautiful handwriting by my students, gorgeous handwriting, the most beautiful pieces of artwork that I've ever seen in my life. So focus on your handwriting. My handwriting wasn't this nice. When I was an undergrad, I worked at it for 4 years to clean it up so that when I write, people can read it. And if I hand my notes to my developers or I hand the notes to my interns or hand the notes to people who work around me, they can type that stuff up and you know, and give it back to me already written out. Okay. Yeah.
What about doctors?
Doctors?
Yeah.
What about it?
They have really bad handwriting.
Do they? All of them? Maybe they can get away with it. But nowadays they have, you know, optical readers where they can write stuff down and it basically converts it into a text. And then they basically review the text and have somebody edit it themselves. Again, but if a doctor has bad handwriting, he writes or she writes a prescription and it's wrong, what happens? You think the doctor's going to get sued when he kills the patient? So, you know, don't kill the patient. Get good handwriting. I'm giving you a lot of tips here on your career. I know some of you probably don't believe it and think that I'm, you know, full of it, but I'm actually telling you all the stuff that you need to know for a successful career. The arithmetic mean. The arithmetic mean. The arithmetic mean. The arithmetic mean. I'm just testing to see if everybody's focused on it. The arithmetic mean. What's wrong with the arithmetic mean as a calculation for central tendency? What's wrong with the arithmetic mean as a calculation for central tendency?
So you
because there's outliers, right? And if you get outliers, what happens to the distribution? It skews, okay? But we want to use the mean, okay? So if we have outliers in the distribution and it skews the distribution, how do we correct the distribution? What do we do? Exactly, we filter the data. Perfect. Okay. The geometric mean. You're going to need to know the geometric mean, because the geometric mean is how the CFAs, the Chartered Financial Analysts at the Chartered Financial Analysts Institute, the people who have the certification and produce the research, that basically report 1 year, 3 year, 5 year, 10 year performance benchmarks, use geometric averages, geometric means for performance benchmarking. Why aren't you writing stuff down? Do you remember everything I say? Okay, perfect. I'll repeat it again if you want me to repeat it.
Yes.
Okay.
Yes, I do.
Geometric mean controls for outliers. It's a more accurate calculation of the mean, particularly when you're doing performance benchmarking. The performance of returns on a portfolio over time. You use the geometric mean or the geometric average to calculate the 1, 3, 5, 10-year performance back tests. Because I want to calculate what my portfolio did on a 1, 3, 5, 10-year basis and compare it to a benchmark. So if I'm managing an equity portfolio, what's the benchmark that I'm using? What am I going to compare it against? The S&P 500. Okay? And if I can calculate, if my rate of return, my geometric return over a 10-year period on my portfolio is higher than the S&P 500, what's that differential called? What's it called? If I take the return on my portfolio and I subtract the return on the S&P 500, what's that delta called? What's it called? What's the difference? What's the spread? What's it called? Anybody know?
Profit?
What?
Profit?
No, I'm using terminology here. You need to write this down. It's called alpha. Alpha. A-L-F-A. Alpha. Which basically means that I outperform the benchmark by 200, maybe 400 basis points, 2 percentage points, 4 percentage points. Does everybody know what a basis point is? How many basis points are in 1 percentage point? 1%. 100. Got it. So if I can beat the S&P 500 by 200 basis points, what's the percentage? 2%. Got it. And if I can beat the S&P 500 consistently over time by 200 basis points, what happens to me as the portfolio manager? And money's going to come in. Okay? Because I beat the benchmark consistently over time. Larry, you and your team, here's more money. You just went from $1 billion fund to a $2 billion fund, to a $3 billion fund, to a $4 billion fund. So if I went from a $1 billion fund and I charge 100 basis points or 1% on the $1 billion, how much do we generate in management fees? How much? 10 million. Yeah, $10 million bucks. And if I can double the portfolio from 1 billion to 2 billion, what's my management fee revenue? No. 1% of $1 billion, now I went to 2 billion. How much are we making now? 40. And then if I take it to 3 billion? 30. If I take it to 4? 40. Can you live off $40 million? Yeah, maybe. Well, you're not going to get to 40, right? Because we need expenses and stuff like that. And my team, us, at Goldman Sachs is going to want to have half of that. So we got 40 million, we give 20 to Goldman, we get to keep the 20, right? Minus the, all the expenses and stuff like that. Let's say we get down to 15 million. Right? How much am I going to get as the portfolio manager? Maybe 5, right? And I got 5 analysts. They're going to get 2 each. Can you live off $2 million bucks? And then the government's going to take half of that, so you walk away with $1 million bucks a year. Can you live off $1 million a year? Can you guys live off $1 million? Yeah. Yeah. Do you think they think like this in New York? Do you think like this in New York?
Yeah.
Yes, they do. That's what they think about. We're talking billions, millions of dollars, and hundreds of thousands. You gotta get out of the thousands and get into the millions and the billions. Okay? I gotta train you to compete against the people at NYU, okay, in Columbia. And they think in millions, in billions. So you need to start thinking in millions, in billions. Okay? Because we're gonna be raising billions of dollars for our funds that we're gonna develop in this class. We're gonna make millions of dollars from the stuff where you're gonna learn in this class. Millions, okay? And you'll be able to take that knowledge and go get a job somewhere, or manage your own portfolio, or come work with me, or I come work with you, and we make millions of dollars. Would you rather have millions or thousands? Millions. Okay, not that you're greedy, but you gotta remember at some point in time, when you start making millions of dollars, the money's not coming to you. You are running businesses, and you're taking care of other individuals in your business, and you sit on boards of directors, and you're taking care of families, and you're sitting on boards, corporate boards, nonprofit boards. So it's not the money, it's responsibility. Okay? And the more money you make, and the more responsible you are, the more powerful you're going to be. Is it power or money that you're motivated for? It's really prestige and power. Okay? The money will come. Normal distribution, exponential distribution, binomial distribution, skewed distribution, Poisson distributions. So different data sets have different behavioral characteristics to the data. And we have to do the data visualization, data analysis, to visualize the data and look at the distributions, and look at the distribution of the data that you're dealing with the data set that you're using. And then you can apply the statistics to those data distributions to get the information from the data for you to be able to make policy decisions to be able to move the business forward, okay? And this is really important when you get into grad school, because you're going to be using simulation software that does body simulation and other kinds of simulation techniques. And you're going to need to do the data visualization before you use the simulation software and plug in what data distribution you're working with, so that when it kicks out the information, you can make business decisions and know that the decisions that you're making are accurate, are correct. So you got to know the distributions. Mean, median, mode. What does that measure? Of the distribution, what does it measure? What is it? What? I can't hear. People. No, the mean, well, close. What's it? I'm testing. If you say something, at least you're trying. If you're not saying anything, you're not learning. You're checked out. So what is the mean, median, and mode?
The mean is the average.
Yeah. And what is that test? What is the average test for?
Yeah, like the most certain, most like.
Yeah. That's what mean and the median and the mode do. They test for central tendency. So you want to write that down. I'm giving you all the terminology, okay? Because I'm going to be talking at this level, in the class. Because I need to get you to produce at a very high level, and I can't be translating everything. You got to understand yourself. So, and do I want the mean, the medians, and the modes to be tightly clustered to each other, or do I want them widely distributed? Tight, yeah. So the tighter the mean, the median, and the mode are, the more central tendency the data has. So I'm feeling really good about being able to calculate means and variances and standard deviations and create regression equations for forecasting. It gives me more confidence. Okay. What does the median do? Yeah, so I rank from high to low and I pick the median value. What does that control for? When I calculate the median as opposed to the mean, what are you controlling for? Outliers, exactly. And what's the mode? Yeah, it's the most recurring. And actually now that we're dealing in big data applications and cloud computing with infinite amount of storage and processing capabilities, the mode has become even more valuable as a recurring signal to probabilities of recurring events over and over again. So the mode has become even more valuable now than ever before. And when you're dealing with bank transactions and those things, you're dealing with huge data sets. I mean, millions of data sets. So the mode becomes a more accurate or more testable than the mean and median. You start moving towards the mode when you're using big data applications.
This is a simple question. I forgot what the mode is.
It's the most recurring. So what you want to do in the, right here, show me the mean calculation, show me all the equations. If you can show me the equations, show me the equations. I want you to burn the equations into your brain. And then show me an example of a median. Just give me a sample, 5 data points, and show me what the mean calculation would look like, and the same thing with the mode. Okay? It's a very simple data visualization. People learn and remember things visually. And that's why mathematics and equations are so powerful, because you can memorize them and burn them into your brain forever. Skewness, skewed, positive skew, negative skew, kurtosis, peakiness in the distributions. You want to show me the diagrams. Okay? And lipocurtic has become even more valuable now. That's when you have skewness in the distribution with fat tails. Okay? If you have skewness in the distribution and you have a fat tail or fat tails, what does that tell you about the data?
There's more data points in one area than others, or like towards one side.
Yeah, the lipocurtic distributions now, I hate chalk because I'm allergic to it, because I'm very sensitive. Lipocurtic. It looks something like that. When you have skewness in the distribution, and you got this big fat tail right here. This is the black swan. Does anybody remember or know what the last big black swan event was?
2008.
Yeah, 2008, 2009. What happened? Financial crisis. Do those things happen all the time? No, not normally do they happen. They're happening more since 1995. They're starting to happen more because the Federal Reserve decides to flood the system with liquidity and basically create asset price bubbles, and then move in and raise interest rates too fast, too far, pop the bubbles, and basically create financial distress. Okay? So these black swan events, that's how they're lipocurtic measures these graphically what these black swan events are. Okay? Because you have this major event, and that's where the value at risk calculations were introduced for risk management purposes, to be able to calculate what amount of capital banks need to hold on their balance sheet if a financial crisis was to occur again. Okay.
Can you repeat that?
Yeah. So these black swan events, the lipocurtic diagram basically illustrates what black swans look like. Something happens really big and it's negative. Okay? Really big. So when these black swan events started to occur rapidly, the 95 peso crisis, the 97 Thai baht crisis, the 98 Russian default, Y2K in 2000, dot-com bust in 2001 through 3, the housing bubble in 96, 97, the financial crisis and housing bust in 2008 through 2011, and then the massive stock market and real estate and bond market bubble that we're currently in today. So the question is, when's it going to happen again? And that's where you have to do simulations and stress tests on the financial institution's balance sheets to say if this financial crisis would occur again, do we have enough liquidity and capital to weather it so that we don't go insolvent or bankrupt? Okay. Histograms. What do histograms measure? We're now getting into data visualization. What do histograms tell you?
The amount of data points to give it in range.
Yeah, in the bins.
Yeah.
So they basically show you a test for normality in your data distributions, right, based on ranges. Stem leaf, box plots, again, data visualization measures for to test for normality in your data. Okay, so those are the, and when I put this thing together, when I read the books, you know, like urban analytics and all these, these come up all the time. So I'm wrapped. These things they need to test you. The variance, when you hear the word variance and standard deviation, what pops into your head? What should be the first thing? I'm looking at the standard deviation and the variance of the returns on my portfolio. What does it measure?
Risk.
Yep. Burn it into your brain. Variance and volatility are a measure of risk. Variance is the dispersion. Standard deviation is the unit. And what you'll see is when we're going through the quiz and writing out all these portfolio equations and portfolio attributions, you're going to see that they use standard deviation constantly in the calculations. It's a normalization unit. Okay? So expected returns, standard deviations, those are normalizations, and then you put them together as equations to be able to measure portfolio performance. So you have to understand and burn in your brain the variance calculation, the standard deviation, and the confidence intervals. Okay? Because the confidence intervals are going to give you an indication of your ability to predict. What are the confidence levels that we use? If I'm testing for statistical significance between the dependent and independent variable, I run the regression. I'm looking at the t statistics and the r squares and the adjusted r squared, the p-values. What confidence levels am I using to test for the statistical significance between the independent variable?
95%.
Yeah, you're going to, in social sciences, we use 95%. If I go down to 90% confidence level, what happens to my t statistics? Do they go up or down? If I go down to 90% confidence level, what happens to the t statistics? Do they go up or down?
Yeah.
They go up. They go up. Okay. Because I'm relaxing. I'm relaxing it. Okay. Yeah, because all the data points don't need to fit into a 95%. They can fit into a 90. Okay. So I'm relaxing, allowing more error to come in to the measurement, and I'm relaxing it, and therefore I'm picking up more correlation. I'm picking up more relationship. So if I lower the confidence level, I inflate the t statistics and the correlations. As I increase the confidence levels to 95, I become more rigid, more strict in my testing. There's got to be really strong relationships between the two. And if my t statistics are significant at 95, then I feel pretty confident in my ability to build the model to do the forecast. 99% is used in the sciences. Very large data sets, really strict, really strict, because you can't, do a 5,000 trial on a cancer or leukemia drug, right, and test for statistical significance and the correlation and the causality between the drug and the person's health. If I'm wrong, I'm going to kill the poor guy, right? So I got to use 99% confidence levels to really make sure that there is causation between the drug efficacy and the outcome associated with the drug's effect. Okay? Yes?
Is it okay if I take notes on the people?
I want you to take, yeah, now. You guys all should be taking notes. I'm giving you all the answers. Yeah, what?
I mean, on the pre-test, on the
Yeah.
pre-test.
Yeah, you should be taking notes. Yeah, you guys should be taking notes. And then what you do is you go back, you do the research, and you fill it in. Because I'm only giving you cursory level. I'm not giving you the detail from the resources. And actually on the website, underneath, and I'll go through that a little bit later, underneath the pre-test, there's a whole series of resources that I've already provided you, so you could Google it and do whatever you want, or you could use the resources available to you, or you could use the book. Okay. All Z statistic, T statistic, F statistic. We usually don't use the student T statistic because it's a non-parametric. We usually use small sample sizes for that. We're always using fairly large sample sizes. So we're going to use the T statistic to measure the statistical significance between the independent and the dependent variable and the ability of the independent variable to predict the dependent variable. Okay. And then the F statistic is the model equation. Is the model with the 5 variables or 4 variables in the model, does the model do a good job of predicting the dependent variable? The answer would be yes if you get a statistically significant F statistic. But the problem is that the F statistic, and we'll talk about this in a minute, if the F statistic is too high, if it's really high, then you have multicollinearity between your independent variables. You're getting a false positive, okay? So you gotta go back and run the correlation matrix on the dependent variable and the independent variables and find the 2 independent variables that are highly correlated to each other and throw one out. Test question. Which one do you throw out and which one do you keep? I got 2 variables that are highly correlated to the dependent variable but highly correlated to each other. Which one do I keep and which one do I throw out?
Drop the one with the highest p-value.
Keep the one with the highest T statistic, right? Or the other one, the other option would be, I can pick the one with the highest statistical significance, or I can pick the one that's been cited the most in the literature based on theory. So which one is it? Do I pick the one and leave the one in that's more statistically significant? Or do I pick the one that's been cited the most in the literature over time and has been consistently cited in the literature as the variable that has the best long-term predictive capability of the dependent variable? Do I use theory in the literature, or do I use statistical significance? What is it? Theory. Got it. It's theory. Okay. Coefficient of variation. Coefficient of variation. Standard deviation divided by the annual expected return. Standard deviation divided by the expected return. Annualized. So it's my unit risk per unit of return. Okay. The risk-adjusted rate of return is the inverse. Do you know what an inverse is? Yeah, you flip it, right? So it's the annualized expected return divided by the standard deviation. So it's my unit of return per unit of risk. So do you want to have high risk-adjusted rates of return or low risk-adjusted rates of return? If I'm an investor, do I want high risk-adjusted rates of return or lower risk-adjusted rates of return? Higher. If I'm an investor, if I'm an institutional investor, do I want high returns or do I want target returns? Target returns. So on the pension fund, do I want a 40% rate of return or do I want an 8 to 10% rate of return? 8 to 10. Because which portfolio is going to have more risk? The 40%. What's the probability of loss on the 40% returning expected return portfolio and the 8 to 10? What's the probability of loss? Is it going to be higher for the 40% or higher for the 8 to 10? Higher probability of loss. And do you think institutional investors that are risk averse like to lose money? No, because they have pension liabilities that they have to target. So they hate losing money. The Sharpe ratio, the Jensen, the Trainer ratio are all ratios of basically measuring risk-adjusted rates of return on individual portfolios. Okay? That's in the book. The covariance. All right. So I got a portfolio. Do I want high covariance or low covariance in my portfolio? Do I want the returns to have high covariance with each other or low covariance with each other? Low. So if the variances in the returns, the covariances in the returns amongst the stocks in my portfolio. If it's low, what am I getting? What do I get? Got it. I get diversification. You're on fire. You're on fire, man. You want to be operating at his level. Okay. You want to be operating at his level. Okay? You're getting diversification. Okay? And then the correlation coefficient. Correlation coefficient is just the covariance amongst the returns in the stock portfolio divided by the state multiplication of the standard deviations. Okay. So the correlation is a standardization. It's a normalization of the covariance. So you take the covariance divided by the standard deviations, you basically bound the correlation between what and what. What's the maximum and minimum for correlation? Because it's set, it's bounded. Yeah, positive 1, negative 1. Positive 100, negative 100. So if I have two stocks and the correlation of the returns are 100% negative, are the returns moving together, not moving together, or moving in an opposite direction? If the correlation is negative 100 or negative 1, they move in pure opposite direction. And what if the correlation is 0?
They don't affect each other.
Yeah, they don't move together at all. Okay, there's no correlation. And what if they're 100% positively correlated? They move together. So if I'm building a portfolio and I'm looking for diversification, what's the range of my correlations that I'm trying to target? What am I looking for? I'm looking for, just kind of give me a range of what the correlation would be between positive 100 and negative 100. If I'm looking for diversification, what am I looking for in my correlations?
0 to negative.
Yeah, negative, 0, or slightly positive. Right? I don't want high correlation. Because if I have high correlations amongst the stock returns, am I getting diversification? No. If I'm getting low, no, and negative correlation, am I getting diversification? Yep.
Yes.
Am I better off if I'm a risk-averse investor and I'm trying to lower the risk in the portfolio? Yeah, I'm going to be looking, you want to target the expected return of the portfolio, then create diversification by bringing in assets whose returns have low, no, and negative correlation. Anybody need me to repeat any of that stuff? Because I'm going to repeat it over again by the end of the semester, like 100 times, to burn it into your
Can you
brain.
repeat the correlation coefficient definition?
Yeah. If you look at the equation, it's basically the covariance divided by, like I have two, let's say I have two stock portfolio. So I'm basically looking at the covariance, the variance between the two, divided by the two standard deviations. So divided by the standard deviation normalizes it and binds it between +1 and -1. So you got to look up the covariance and the correlation equation and write it down. Okay? I'm making you do the research. You got to work to find this stuff. I'm not giving you everything, but I'm walking you through it. You need to show me the portfolio standard deviation equation. There's two equations in the book. Okay? There's one with the covariance on the end, and there's one with the correlation on the end. So you need to go find it. Don't put in the variance or the standard deviation equation. I want the portfolio standard deviation equation. There's two of them. Okay? Okay, time series regression. I'm going to have to go back here because I can't write on a chalkboard because I'm very sensitive to the chalk. So you're going to have to turn around. So this is the regression equation that I want you to write in there. And then I'm going to go over it again. Is everybody familiar with cross-sectional and time series regression? Statistics? Yeah, no, yes, no, yes, no, no, yes. This is the dependent variable. The happens is an estimation. We've got the alpha, that's the intercept. Okay. Plus the beta hat 1, your first variable coefficient. Variable 1. Plus beta hat 2, x2 plus beta hat 3, x3 plus beta hat. How many variables do you want in your regression model? As many as you can get, or limited to how many? You don't want to go beyond how many variables in your regression model? 5. If you go beyond 5, what happens? You get multicollinearity. Your adjusted R-squares and your T-statistics are going to get all whacked out. Your P-values are going to get messed up. Your adjusted R-squares are going to look great. You're going to think you're brilliant. But no, there's misspecification within the model. Or x4 plus beta. And you don't even need 5 variables in most cases. And you're going to have macro factors and micro factors in there. Beta at 5, x5. And what's the last one? What's the last variable in the regression equation? What's the last one? What's this one? This? Nothing? 0? Something? Nothing? It's either nothing or something. Do you think there's something or nothing? Something's going to be on that here. It's your error term. We're going to use the mean squared error, the MSE. Right. So you got your regression equation, I got the data. Going to fit the regression line through the data points. Right? This is your alpha here. And then what you're going to do is here's the regression line. Is there a lot of error in there? No. So what you're doing is you're basically calculating the error percent. Do you want the data to be tied around the regression line, or do you want dispersion around it? In line. So that's basically what it looks like. And then you're going to collect the data, right? Over time. What's the most important variable if I want to forecast stock price movements and returns in stock? What's the #1 accounting variable that I would look at? Pick one accounting variable. What's the #1 variable, accounting variable, that would be the predictor for stock price appreciation or stock price movements? Yeah, I could use EPS, earnings per share, or FF, or EBITDA per share. Does everybody know what EBITDA is? Earnings before interest, taxes, depreciation, amortization, free cash flow per share, earnings per share. Or if I'm doing the accounting, I could probably do ROE, return on equity. So if I have the return on equity for my company going back 10 years, and I want to forecast future return on equity, I'm probably going to get a historical time series. Is 10 years pretty good? Annualized, quarterly basis, monthly, ROE, because it's reported on a quarterly basis. Oops. This is the data. Right, so I'm going to collect the data. This is my data set here. Boom. First thing I'm going to do is run the correlation, correlation matrix. Right? I'm going to test to see if there's any correlation between the independent variables and dependent variables. So I'm probably going to run single regressions. One variable regressions on a dependent variable. Test the T's, right, on it, the correlation. Test it individually. Then I'm going to do the correlation matrix. I'm going to see what variables are highly correlated to the dependent variable and which ones are highly correlated to each other. Throw the one out that hasn't been cited the most in the literature, and basically build a forecast. Run regression. I'm going to test the T statistics. These T statistics are statistically significant. And I got a really good model first. Then I'm going to test the F statistic. See if the model does a good job predicting the dependent variable. I'm going to look at the adjusted R square. R square, adjusted R square. There's other regression diagnostics that we look at to see if the model is doing a good job. Right? Then I run the regression, it kicks out the coefficients. Then I basically forecasted independent variable data, multiply it through by the coefficients, kick out my forecasts. Is that valuable? Heck yeah. Right? If I can forecast the future, I'm going to get a promotion, keep my job, get a bonus, get some salary. Because I can predict the future, I can advise my clients, advise my company on what they should be doing based on the projections. Okay? So that's basically, that is what that should be in that space right there. Okay? I got time series, right? Working on IBM. I got basically ROA, return on assets. I got sales projection, right? Because they're all going to have an effect on ROE, right? Probably leverage. Debt to equity, debt to total market cap, and maybe some other variables in here that are going to be statistically significant in predicting the ROE of the firm. But that's IBM. IBM's been around like 80 years. What if I'm a startup company? And I want to be able to forecast what our ROE is, but we've only been around for 2 years. We've only reported for 2 years, so I only have 8 data points. So I can't do time series regression. I got to do what? I got to build the model. I've been asked to build the model. Build the model. Oh, I can't build the model because I don't have enough data. How do you solve it? Go ahead.
Build projections.
Yeah, but I got to do the regression first. So I can't do time series regression because I don't have enough history. So I have to do what kind of regression?
Cross-sectional.
Cross-sectional regression. So can I go find basically a sample pool panel of similar firms in our industry of the same size and same characteristics, and basically create a pool of them and collect the data and run the regression, come up with the coefficients, and then put in our projections for our firm and be able to forecast what the ROE is for our company? Can I do that? Yeah. So being able to go back and forth between cross-section and time series. Like I know that if you don't have enough data, you use cross-section. And then you can do the forecast. If you have enough time series, you use time series. Or maybe you do both. And test. You do both a cross-sectional regression analysis on your sample of firms that you're looking at. You do the time series on the firm that you're looking at, and you run the regressions, and you look and see if the beta coefficients are stationary, are similar to each other. That's validation verification in your modeling. That's validation verification. Do you want to validate and verify all of your assumptions? Yeah, do you think that the executive committee, the chairman of the data analytics division, financial analytics division, is going to be asking you questions on how you built the model and what the regression diagnostics were on the regression equations that you tested? Is he going to, or she going to ask you those questions? Yeah, and if you can answer those questions, you're in. If you can't answer the questions, you're out. And if you can't answer the question, what's the answer? Yeah, like, we didn't look at that, or we probably should have been more rigorous about it. What's your recommendation? What should we do? And what we'll do is we'll go back and back test it for you, do the validation verification, and we'll get back to you in 2 days. Great. I don't know, it doesn't work. No, it doesn't work. It's, you know, we did look at that a little bit, but we probably should have been more exhaustive. Give us a couple days, we'll rerun it, and then we'll get a whole, we'll do a conference call, or email you a write-up. And if you have any other questions, let us know, do a Zoom call or whatever it takes to make you feel comfortable with the model that we're building, that you're comfortable with, and we'll do a good job of predicting. Okay. So there's politics in this. Okay. We know what the dependent variable is. That's what you're trying to forecast. Okay. So how do you know what dependent variable to use? Test question. How do you know what dependent variable to use? No. You got a consulting assignment, you just got hired. You know, how do you, they asked you to build a forecast model. How do you know what dependent variable to use? What? Yeah, they're going to tell you. We need to forecast, you know, production. We need to forecast sales. We need to forecast revenues. We need to forecast earnings. We need to forecast returns. So it's usually the client that's going to tell you what the dependent variable is that they're trying to forecast. Or they're going to come to you and say, Larry, we need you to come in because we just started our company. We know that you've worked with other companies before. What are the metrics we should be looking at, and what are the metrics we should be forecasting? So they may ask you. Okay. And then, how do you determine the independent variables? What's your name? Oh, I got you right in with I got it with the chocolate in your mouth. Okay, excellent. How do you determine the independent variables? What's your name? Jaime?
Yeah.
Jaime, we need you to do a forecast model. What metrics should we be looking at to get a good idea of the stock price appreciation over the next 8 quarters? We should be focusing on ROE. Okay, great. Build us a forecast model. Have you ever built a forecast model before to predict ROE?
No.
No. So what would be the test question, the scenario? Jaime, I want you to build us a forecast model. I want you to build us a forecast model and forecast ROE because it's the #1 factor that will allow us to be able to predict the direction of our stock price. Have you ever done it before? No? Do you want to do it?
Sure.
Yes. Okay. Yes. And then the second question that comes out of your mouth, you need to write these down. What's the second question that comes out of your mouth? Yes, I will do it. And now you start the series of questions with your sponsor. What are the questions you need to be asking him or her? You got yes, came out of your mouth. Now you start the process. When do you need it? What else?
Yeah, and then just be like, oh, this is about.
Come on, you business students, you business majors. You guys are all going to be managers, managing some product development, some team. You're going to be asked these questions. When do you need it? Give me the series of questions. Yeah, who am I working with? Do I have enough resources? Do we need to hire people? Can I get people from, inside the team, outside the team? Do we have to hire consultants? So if I'm hiring consultants and I'm taking resources from other departments or other divisions, what's the third question I need to ask? Yeah, what's my budget? Are you going to give me a budget? Is it on a shoestring? What else? What's the other thing I'm going to need to know? I want you to build me a forecast model. Great. What do you want to predict? ROE. Excellent. Have you ever built a forecast model before? No. What's the next question?
Can I see one?
Yeah, do you have an example of it? Or the other one that's even better is, what do you think drives ROE? Do you think the person that is asking you the question has years of experience? Yep. Have they ever done statistical modeling and stuff like that? Maybe, maybe not. But if you got 20, 30 years of experience, do you think you know what drives ROE? So you ask them, what variables do you think drive ROE for a company like ours? Or other companies like ours? So you ask. Would you ask anybody else? Who else would you ask? Not yet. No, because you need buy-off on this. You have to convince them that you're capable. If you go straight to the internet, they know you're a hack. Okay? So who else would you be talking to? You already asked the sponsor. Who else would you be talking to? Now think about it. Who else in the firm should you be talking to? I'd be talking to people in accounting. I'd be talking to people in sales. I'd be talking to people in the company and doing a survey and asking them what variables drive ROE for the company or companies that you've managed before in the past. Excellent. Now what do you do?
Yeah, you Google.
Google's one way of doing it, but where would I go first? Define the variables that predict the dependent variable. No, where would I go? What? I go to literature. I go hike over to the library or log on to the library, go up to EBSCO and ProQuest and look at peer-reviewed journal articles and industry research reports over time that have basically researched what are the variables that consistently predict ROE for companies. So I go to the literature and I read every single article and I find variables that have been consistently predicted over time in forecasting ROE. And then start testing the variables and putting them into the model. Then back testing the model to see if it actually tracked and did forecast well, going back in time based on the back test. And then I would do the projections on a tracking basis over a short period of time to see if it still was working, and then I would make the projections. And then once you've done the projection, now what do you do? So you've done the research, you built the model, you tested it, it works, it does the forecast, now what do? You create a presentation, right? You write the report, you do the presentation, you get out the report, presentation, the board of directors, you get their feedback, you refine or improve the communication, then you go do the presentation at the quarterly meeting, or at the product launch, or at the model launch, and you make the recommendations on what they should do. What variables should the company be focused on that they can manage that will drive ROE for the company and increase the stock price? That's the process. Okay? All right. These are very long answers and very short questions. Tests for variable and model significance, we already went over those. Multilinearity, we already talked about that. What's internal validity? Do I need internal validity when I'm building a forecast model? Do I need validation? Yes. Do I need internal validity?
Yes.
Yes. What is internal validity? Can you look that up? Sure. Very simplistically, internal validity is you need internal validation. You need confirmation by other people within the firm that have experience, that when they look at your model, you say that totally makes sense. Those variables that you've come up with make sense. The results of your research make sense. It's intuitive. So now you're getting buy-off and internal validation and verification. If you have anybody within the firm that questions your modeling capabilities, questions your results, and questions the value of your model, it ain't gonna work. Okay? You need internal validation. What's external validation?
Maybe that the model fits compared to other companies similar to yours.
No, I'll just tell you, external validation is that you've gone to the literature and you validated that the model that you created is consistent with other models that have been created in the past, although you brought in maybe one or two newer variables because that data wasn't available historically, because you were very innovative and you had a certain data set, or you created a data set that nobody's ever created before. Okay. or a variable? Do people create variables all the time? Do people create indexes all the time? Yeah, S&P 500, the index guru of index construction, they have hundreds of thousands of indexes that they've constructed for predictive capability and measurements on behalf of their clients. Okay. Systematic risk, can I diversify that away? No. Can I diversify away unsystematic risk? This is specific? Correct. And put a footnote, you get the graph, it's but if I add a bunch of stocks to my portfolio and I diversify away all the unsystematic risk, and that's all that's left is the systematic risk, what's the statistic, what's the measure of systematic risk? What would I use to measure? Got it. Got it. The data. What's the capital asset pricing model equation? What's CAPM? What's the equation? Can you look it up? Does anybody know it off the top of your head? You need to memorize it. Because they're going to ask you. That's good thinking. Great, what's CAPM? We're going to look it up. Eric, next. Seriously. What's the standard deviation? Next. What's the normal distribution? Next. Do you think there's people out there that know that stuff? Yeah, we're all replaceable. So you can create a competitive advantage. What's CAPM? How do you calculate the expected return or the equity cost of capital using CAPM? What's CAPM? Can you look it up? Can you Google it in 2 seconds? Can you go on the computer, go on the internet? Why not? You have a computer in front of you. Do it. You're the most powerful generation on earth. You have answers in front of you. You can pull stuff up in 2 freaking seconds. You're going to be sitting in these meetings. They're going to be asking you questions. You're going to have access to the internet and the intranet. And they're going to ask you questions. And the person that gets the answers quickest wins. Risk-free plus the beta. Yeah, times the market risk premium, which is the return on the market minus the risk premium. Excellent. Okay. And the beta is the systematic risk. Got it. Okay. We're almost done. You need to write out with the, show me a balance sheet, assets and liabilities. Do you want to match? Do you want to match the maturity of the liabilities with the economic life of the assets? Yes or no? Do you want to match the maturity of the liabilities, the economic life, the physical life of the assets? Yes or no? Do you want to match the maturity of the liabilities with the economic and physical life of the assets? Yes or no? It's an easy thing. It's easy. You got like a 50% probability of saying yes or no. One's right, the other one's wrong, but you got a 50% probability of being right. Is that pretty good odds? Yeah. So do you want to match the maturity of the liabilities with the economic and physical life of the assets?
Yes.
Yes. Got it. So I'm going to use short-term liabilities to finance short-term assets. Right? Commercial paper for inventory. Right? I'm using short-term lines of credit for inventory and short-term assets. Plant and equipment, not plant, but let's say machinery or computers that I can write off and depreciate in 5 years. What bond maturity do I want to issue to finance 5-year machinery? 5 years, I got equipment, it's going to last 5 years, it's fully depreciated in 5 years. What's the maturity of the bonds that I'm going to issue to finance the equipment? 5 years. Got it. So I want to match. I want to do asset liability matching. I don't want to do mismatching. Okay? I don't want to use short-term liabilities to finance long-term assets. I want to use long-term liabilities to finance long-term assets. So if I'm buying and building a manufacturing plant, what am I using? What liabilities am I using? What part of the capital stack, capital structure, am I using to finance the development of the multi-billion-dollar chip manufacturing plant? What am I using to finance it? What's the maturity on the loans? I'm building a manufacturing plant. I'm Intel. I'm building a manufacturing plant in Folsom. I'm building a manufacturing plant in Washington County up in Portland. What's the financing source that I'm gonna use? And what's the maturity of that financing source to finance the plant? What's the maturity? What am I using to finance the plant? Come on, finance majors. I'm using long-term. So what are the long-term liabilities? What? That's correct, but what am I using? What's the maturity? What's the instruments that I'm using? What's the maturity on those instruments? What am I using? I'm using bonds. What's the maturity on the bonds? 10-year for a 30-year plan? Let's say the plan has a 30-year life. So what maturity of the bonds am I going to use? If it's 30-year life, I'm using 30-year bonds. If it's 10-year life, I'm using 10-year bonds. If it's a long-term asset, I'm using long-term liabilities. So I'm probably using 10 to 30-year bonds. What else am I using to finance it? What's another long-term liability? What's another long-term liability? In that liability line item, down around the bottom, what else is down there in the balance sheet? Can you look up a balance sheet? Can you look it up? Can you Google it? Can you pull up a balance sheet in like 2 seconds by just Googling it? Balance sheet, boom, click on the highlighted thing. Go right to an example of the balance sheet. What else is in there? What? That's short term. What is it? What? Loans? Yeah, we already said long-term loans. We said 10 to 30 year maturity bonds. There's another long-term liability, just yell it out. Notes payable, but notes are notes. I'm trying to get to the answer. There's another one in there. Long-term debt, we already said 10 to 30 year bonds. Can you look it up? The answer's not on the wall. You guys gotta be engaged and start looking for the solutions. Okay? Because you're gonna be in a meeting, they're gonna be asking you questions, and you gotta dig the information out. If you don't know it, you look it up. What else am I using? In the capital stack, long-term liability, what am I using? You gotta be engaged. Remember, this is a laboratory class, this is not a lecture. So you're gonna be doing most of the research, you're gonna be answering most of the questions. When you go work for somebody, are they gonna be asking you questions? Are they gonna be asking you questions when you go work for somebody? Constantly. Yes, and you need to, don't raise your hand, just yell it out. What is it? Deferred revenue? That's not a major source of capital to finance long-term assets. That's short-term. Do you guys all have your balance sheets up? Are they going to be ranked? How do they rank the assets and the liabilities? From long-term to short-term or short-term to long-term? Short-term to long-term. So where do you look on the balance sheet? Shareholders' equity. Do you think maybe I'm going to issue some shares to raise the capital along with the bank loan and the bonds to raise the capital I need to invest in the $2 billion chip manufacturing plant? Yep. So I'm going to be issuing equity and debt. Okay. Is equity long-term or short-term maturity? When I issue equity, does it have a finite life or an infinite life? So it's long-term. Right? It's infinite. Long-term. What's cheaper, debt or equity? What's cheaper to raise? If I'm going to raise some capital to invest in the plant, do I want it, which one's cheaper?
Equity.
Equity or debt? Debt. Why? Why is debt cheaper than equity?
Because they're the first to be paid out.
That actually does put them in a position. That's a component, but that's not the main reason. No. There's a reason why debt is cheaper than equity.
Interest is tax deductible.
Got it. The interest on the bonds are tax deductible. So are you gonna use more or less debt? More debt, because it's cheaper, right? So equity is always gonna be expensive. So what do you, when you're financing something, what do you wanna use, if you can? Debt. Can you use infinite amount of debt? No. If you over leverage the firm, what happens? And you go into a recession. You default on the bonds, bondholders file a lawsuit. They basically force you into bankruptcy, liquidate your assets if they're looking to get their money back. So that's the two-edged sword. Corporate income statement, right? Pro forma, projected income statement, income statement. And there's financial ratios around that. And then the cash flow statement, where the sources of funds coming from, sources and uses. And then the key financial ratios. These are just the key ratios. Test question. Test question. If I'm buying a company, I'm going to buy a company, and we are going to project out the free cash flow for the company over the next 5 years after we take it over, and then what we can spin the company out at some point in the 6th year. What discount rate are we going to use to make that capital budgeting decision?
A lot.
We're going to use the weighted average cost of capital. Got it. Excellent. Which one's higher? The CAPM calculation for the discount rate, or the WACC calculation for the discount rate? Which one's higher? CAPM or WACC? Which one would be higher? CAPM. And what does CAPM measure? What cost of capital?
Cost of equity.
Cost of equity. Excellent. Nice. And actually the underwriting fees by the investment bank are more expensive for the equity than the debt. Okay. Did you have a question or something? Or you just, did you want to come in and
No, I was
hang
waiting.
out? You want some chocolate?
No.
Wait, could you say that last sentence again?
Yeah.
About underwriting fees
Yeah.
and then.
Well, let me step back a little bit. So the weighted average cost of capital is the discount rate that you're going to use to make capital budgeting decision. The WACC is always going to be lower than the CAPM calculation, which is the calculation of the cost of the equity. Okay. The cost of the debt is going to be cheaper because of the tax deductibility associated with the interest on the bonds. Equity is also going to be more expensive because the underwriting fees are higher. So when the investment bank underwrites an equity issue, a seasoned offering, a secondary offering, they're going to charge higher fees as opposed to issuing debt. There's lower fees. Okay.
Why?
Huh?
Why?
Because the underwriting associated with the distribution costs. It's harder to sell a secondary offering. You gotta do more underwriting, and then the investment bank may decide we'll do a firm commitment or we'll do a best efforts. Firm commitment, what we'll do is we'll raise the equity for you. What we'll do is we'll tell you what the price is going to be, and what we'll do is we'll buy the whole issue from you at X price, and then we'll take the issue, and since we've underpriced it, what we'll do is we will distribute it through our distribution channel, and the value of the shares are lower than the market value, so they make not only the underwriting fees, but they make the pop on the distribution of the shares because they issued the shares, they bought the shares below the market prices. So the investment bank's a very lucrative business. Not only do you make the underwriting fees, but if you do a firm commitment and you take out the whole issue, and you basically then resell the shares in the marketplace at a delta, you're going to be able to pocket that money, that spread. Best efforts is the investment bank says, I'm not willing to take out the whole issue, but what we'll do is we'll bid it out to a bunch of other investment banks and other private equity investors and other investors that will bid on the issue, and we will basically sell the issue off in small tranches to individual investors that are willing to give us the best price. So this is you're doing the best you can, the others, they're taking it out. Okay? And then the arbitrage pricing theory is another methodology similar to CAPM. CAPM is a linear model. Arbitrage pricing theory is a multi-factor cross-sectional regression model that uses macro factors to be able to forecast expected returns on the stock. Okay, so it's a different approach. Then on the back here, the next page is showing me the different models. Perpetuity model, basically next year's cash flow divided by I. Okay. Gordon growth, next year's cash flow divided by I minus G. Multiple approach, next year's cash flow multiplied by next year's PE multiple gives me the value. And then the discounted cash flow, the cash flow is projected out over the holding period, projected out one more year, use perpetuity or Gordon growth, depending on if you assume that cash flows are going to remain flat or grow at a constant rate forever. You calculate the terminal value, you got the terminal value, last year's cash flow, and you discount it back to the present to get the present value, which is the intrinsic value of the real estate, the REIT shares, the stocks, whatever it is you're trying to value.
Can you repeat the Gordon growth and we'll...
Yeah, the Gordon growth is the next year's cash flow divided by I minus G is Gordon growth. In the models that you see in the books, they usually use dividends. Nobody uses dividends for valuations. You use earnings per share, or you use EBITDA per share, free cash flow, which you're using as the numerator. And it's the expected return minus the expected constant growth rate over time. And I'll get into this a little bit later now, I'm just kind of going over it kind of quickly. And then everybody knows what the present value calculation is. The discounted cash flow of the DCF. I'm not going to get into the next portion. That's like the first part of the pre-test. And then what I'll do is I'll go through the second part with you. Okay. And I'll just tell you, the second part, first question is, do you care about what the Federal Reserve does? Do you care? Yeah. The Federal Reserve basically brings the punch to the party, and the Federal Reserve takes the punch away. Okay? So everything in the economy is basically determined, the business cycle is determined by the Federal Reserve policy. So do you care what Yellen, Bernanke, Powell, all of those prior chairmen, do you care what they say? Do you care what they do? Absolutely. Okay. So I'll get into that. We'll get into the quantity theory and money calculation, and I'll show you the transmission mechanism of money supply growth rates on GDP and real GDP and inflation. So I'll kind of walk you through the model, that'll be a refresher on your map. And then yield curve dynamics. Does everybody know what the yield curve is? Yield curve, basically the interest rate on government bonds, risk-free bonds, based on maturity. If the yield curve is normal, is it inverted, flat, or upward sloping? If it's normal, it's upward sloping. And why is it upward sloping?
Because the value of it goes up as the bonds.
Not necessarily. It's because of the Fisher equation. The Fisher equation determines the yield of maturity, or the interest rates on risk-free government securities. And the Fisher equation is the real rate of return plus inflation expectations. That's the simplistic Fisher equation. So if inflation expectations go up, interest rates go up. Okay. And yield curves can shift up, shift down, flatten, and invert. So it's a very dynamic. But the yield curve is the #1 factor that determines asset prices. Real estate prices, stock prices, bond prices. So before you can value any security, you got to start with the yield curve. You look at the yield curve, you got to look at base rates along the curve. If I'm going to issue a 5-year bond, how do I price it? Where do I go to determine the interest rate on that corporate bond? What's the first interest rate that I use before I start tacking on various premiums. If I'm gonna issue a 5-year bond, what do I go look at first? What's the first thing I look at? What? I look at the yield curve and I go to what maturity? If I'm gonna issue 5-year corporate bonds, I look at the 5-year. Okay? And then I start tacking on those premiums to get to the yield to maturity for the corporate bond. And that's gonna determine the price. So the price of real estate, stocks, bonds, derivatives, everything is priced off the yield curve. So all asset prices, all financial assets are priced off the yield curve. So it's critically important that you understand yield curve theory, that you understand monetary policy and macroeconomics. And what's one of the prerequisites for this class? Economics. The next one, and I'll show you this next week. Yield curves in the S&P 500. I will show you next week. Type in dynamic yield curve. Dynamic yield curve. Okay, it's on stockcharts.com, and you guys are going to be using stockcharts.com a lot. Type in dynamic yield curve. And what we found out in my classes, and when I've been teaching this class, over the years, one of my students said, Professor Susan, look at that. I said, look at that. He said the yield curve inverts within a year of the peak of every stock market peak. The yield curve inverts within a year before the stock market peaks. And once the yield curve inverts, we're in a recession within 24 months. The yield curve is the most accurate predictor of recessions. Is that valuable to know? Yeah. And what happened 2 months ago, within the last 2 months, what happened? The yield curve inverted. What happened to the stock market? It sold off. Yep. And what's happened since then to the yield curve? Yeah, it went back to normal. Because the Federal Reserve stepped in and started buying short-term bonds, driving up short-term bond prices and driving up interest rates to get the yield curve normal again so we wouldn't go into a recession, particularly in an election year. Okay? So it's the #1 factor. So it's really good. You need to start tracking the capital markets, the 5 major asset classes. When I come in to class, the first thing I'm going to go is let's go through it. Where did the Dow Jones settle today? Is it up or down? Where are oil prices today? Are they up or down? Why? Where are gold prices per ounce today? Did they go up or down? Why? Are stock prices trending up or down? Are oil prices trending up or down? Are gold prices trending up or down? Why? What are the economic factors that are driving the prices up and down? And I'll walk you through the microeconomics, the Marshallian microeconomic charts behind these major asset classes so I can train you to have this stuff in your brain. Because that's what the traders do. The traders know it, the CEOs, CFOs, CIOs, they know all this stuff. Okay? You got to know where the 10-year treasury is yielding. Up or down, why? And then the last is you need to know where the dollar to the pound, dollar to the euro is trading. Maybe dollar to the peso, dollar to the ruble, so there's obviously international capital flows, merchandise trade flows that are going to have impacts, on currency values. There's a whole theory behind what are the factors that drive currency values. Those are the major asset classes, those 5. Trillions and trillions and trillions and trillions of dollars are invested in those 5 major asset classes. Trillions and trillions and trillions of dollars flow in and out of those asset classes every single day. And your finance majors, that's all you have to do is get your little body in front of those capital flows and be able to get a piece of it. Okay? If you get a piece of it, you're going to get a lot of it, because it only takes a little to get a lot. Right? And they're not going to give you the money. They're not going to just give it to you. You got to earn it, and you got to know your stuff. Okay? And then on page 16, I'll go through the supply-demand analysis, the factors, both on the supply factors, demand factors, that basically shock the supply and demand curve and drive prices up and down. Okay? So I'll burn that into your brain. The next on page 17, and actually there's a link on the syllabus of the financial product innovation in engineering. Finance is just a technology. It's an engineering process. We build product. We build process to solve problems, period. Finance is engineering. You all are financial engineers. I want to be a financial analyst. No. I want to be a financial engineer. Yes. What does a financial engineer do? Uses finance to solve problems. Okay? Through mathematics and statistics, we design the products, they solve the problem, we go out and market those solutions, those securities, those techniques, those tools to the marketplace. We make a market in those products. We build it, we manage it, we build the capital markets. We become experts, and then we do it over. Okay? So what does it take to invent financial product? Well, it takes all of these factors. There are certain conditions and certain factors and certain psychologies, organizational structures, and, certain types of personalities that you need to have to be creative to create finance solutions. So I'm just taking it from the marketing literature and I'm applying it to finance. And your investments book is basically just a book about financial product innovation. Those are all financial products and processes that have been developed over the last 80 years. Okay? Securities are just an engineered product, a standardized product. Derivatives are just standardized products. Stocks and bonds are just standardized products. Insurance products, annuities, all standardized products. Okay? Finance is amazing in how creative it is. Page 19, modern and postmodern portfolio theory. The theory behind constructing the portfolio. Okay. Alternative assets, energy, real estate, insurance. What does it do to the portfolio? What does it do to the efficient frontier? So I'm going to walk you through modern and postmodern portfolio theory, and then you're going to apply it in the class. But you got to understand the theory. Okay? I took Markowitz's model, just his basic framework that he developed, in 1957, when he got the Nobel Prize on modern portfolio theory, and I've modified it over the last 10 years to make it more relevant and more applicable. Okay? And then now, if I'm building a global portfolio, right? I'm building a global portfolio, and the capital allocation line, right? The risk-free rate is assumed to be positive. In theory, in your books, is assumed to be positive. The assumption is that risk-free rates on government securities should have a positive yield. That's the theory. It's still in the book. But the reality is that governments have printed money and driven interest rates negative for the last 10 years. It's not even in the book.
Can you say that again?
Yeah.
Risk-free rates?
Yeah. Risk-free rates, and yields on government securities, have always been assumed in the finance literature to always be positive. But over the last 10 years, due to the financial crisis and quantitative easing, central banks across the globe have printed $55 trillion out of thin air and have bought government securities, driving their prices up and driving their yields negative for the first time in history. What is the effect of negative interest rates, not only on financial assets and real assets, but on portfolio design? Okay? It's reality. Okay? They teach you theory in your books based on 30, 50 years of theory. The theory needs to be modified based on the reality of what's occurred over the last 10 years. It's not reflected in the theory, because the theoreticians, not application. They're not applied economists, they're theoretical economists. Okay? We don't live in the theoretical world, we live in the real world. Okay, so I will show that to you. There's also derivative strategies. I will go through derivative trades with you. If you think that the indexes and the prices are going to go up or down, there's certain trades you're going to make, and I'll walk you through those trades. You're going to have to put in the definitions, and I'll walk through some of the definitions of the derivative contracts. Forwards, futures, options on futures, swap contracts, buying on margin, going short. Page 21, we're going to go through technical analysis. Okay? And then in class, I'm going to give you my technical trading method and show you that if you adhere to my technical trading methodology, you will be guaranteed to make money. Guaranteed. You will not lose money. Ever. And if you're smart, you will take the methodology that I train you in, you will put money in a qualified account, self-directed IRA, and you will trade that account for the next 40 years and come out by the time you're my age with $3 to $4 million. Guaranteed. If you believe it. Professor says it's crazy, I don't believe anything he says. No, we tested over the last 5 years with all of my classes. I could do that too. Okay. So the pre-test. How are we doing on time? Probably get a faint or something. How are we doing?
We end at 10:10.
What time is it?
It's 9.
It's 9? Okay, so let's do 20 minutes and then we're out of here. Okay? All right. Anybody need any chocolate? Chocolate? We're only up the street from.
Might as well.
Yeah. Let's get a dose up on some chocolate, man. No, let's do it. Okay, so what we're going to do is I'm going to show you some applications. So you guys are going to produce. Oh shit! I left it down on the application. Okay, so I can't show you the numbers, but what I'll do is I'll pass around the numbers. So these are the trading numbers. You guys can take pictures of these. And one of our authors is here tonight. See, hi to everybody. Yeah. He basically authored some of these memos. So what you want to do is take pictures of these. So these are basically the technical trading briefs. Okay, I'm going to train you on how to write technical trading memos. Okay, these are the memos you're going to give the managing director, executive managing director of the trading division at 4 o'clock in the morning, every other day to give them an update, not only on where you think the markets are going to go, what trading opportunities are available to our proprietary trading unit and our customers, okay, our clients. So this is the formatting of this is very technical and very precise. Okay, you can't just hand in crap. Okay, I'm going to work with you on how to write these memos. I'm going to train you on how to forecast where these markets are going to go based on certain economic factors. Based on the direction in which you forecast, we'll set the trades. And then what you're going to do is add in some evidence, some data, and some graphics that support your forecast and your directional recommendation. Okay? So you guys can hand them around and do that. Let's do this one. If we have any bandwidth in the class, and I may try to drive you guys more, here are the intrinsic valuation reports. Is that a beautiful report? Mm-hmm. Yeah, it's a beautiful report. My students did this. We worked on this together to make sure it was perfect. This was the intrinsic value of JP Morgan. Okay, this is a deck. Okay, this is a pitch book. This is what you're going to get deployed. This is what you're going to give the executive team. Take pictures of this and pass it around. These were the best ones that I found. Okay. Value in stock. Right? You got to value the stocks before you put your portfolio together. Every quarter, you're going to revalue the stocks to figure out which ones to buy and which ones to sell, which ones to keep in the portfolio. So you're going to be doing intrinsic valuation on the individual securities within the portfolio. So this is the report. This is basically the base deck for the CFA challenge. Everybody know about the CFA challenge? We put together teams every year to compete against other schools. We're doing electronics art this year. And we're basically valuing electronics art. We're putting together a report and a presentation. And we're going to go present. I'm not doing it, my students are. And we're going to go present in front of a jury, and they're going to compete against other schools. If they win, they go to the regionals, and then if they win again, they go to the nationals in New York. All right, so take a look at that. And then lastly, and I'll see if I can get through this quickly. So this is deliverable 3. Okay. This is the final product. Okay. This is the final product for the class. Right. This was Rebecca Chels. Does anybody know Rebecca? She's awesome. She's totally badass. Here's an example of the final, which is easy. She's got her resume, which I worked on with her, so it's perfect, ready to go. This is and keep it together. This is the stock portfolio report. Okay, it basically takes does all of the analysis. You can see the memo. And actually, I have samples of prior reports, although I think this semester they produced the best reports, so they're going to give you the best reports. So I'll update those so you have the highest quality of templates to be able to work from. And basically, we did 3 portfolios. We did a passive static portfolio. We did an active portfolio using optimization techniques, using Excel. We developed a target portfolio. We did fundamental securities analysis using a fundamental securities template that my student program gave to us to use in this class. And then another student of mine developed the profit loss statement around the moving average crossover trading system that I developed. He basically created the profit loss model to basically show in a back test how much money you can make if you implement the trading strategy. And then it's all in a final report that's bound and published. Right? Do you think this would be powerful to walk into an interview with? Yeah, they're going to want, Julia told me that she showed this stuff to her boss, and she got the RBS, position, right, in New York. Here's the PowerPoint presentation. We do 3 of them. You're going to present the passive, static portfolio presentation. You're going to do the active, and then you're going to do all 3, roll everything up together and do a formal program presentation as though you were giving it to the investment committee of a hedge fund or maybe an investment bank. Okay? Because you guys are hired to develop a product. Okay? And then you have your individual reports, your attribution, your performance benchmarking, presentations, passive, active. So these are I'll pass these around. Keep this together. I don't care if you take pictures because your portfolio is going to be different, but you'll know exactly what the standard, the quality of the product, reporting product will be. Here are some others. Active. Here's some more. Here's the stock valuation.
You want us to take one of these? You just have to-
No, just take pictures of everything, and I'll bring copies of everything. So don't pinch this stuff, okay? Because I need it for my other classes. Here's a good one. DTC stock portfolio trading system. Do you know how much this thing's worth? Do you know how much intellectual property I put into this thing? Of my own intellectual property? Do you know how much this thing is worth? Portfolio production, trading systems. Yeah, this thing's probably worth like $25 million. Do not give it to anybody, do not show it to anybody. Okay? If you do show it to anybody, redact some of the stuff, and then make sure you have an employment contract. Okay? But don't give it away. Okay? It's mine, that I'm giving to you. To use. Do not give it to somebody. Okay? They don't deserve it. No other professor is going to give you the intellectual property. None. Zero. Stock portfolio report. Here we go. You want to take pictures of it, pass them around. Here's the presentations. Take pictures of it, pass them around. I'll give you some templates, but you need to see the quality of work that me and my students did together. Okay. If I showed this to a potential employer, do you think they would give me a job? If I show a bunch of multiple choice exams with A's on it, do you think they're going to be impressed?
No.
No. The goal is to basically train you to produce product at the quality level of the investment banks, the private equity firms, the venture capital firms, the financial institutions, the foreign financial institutions, the sovereign funds. The standards are all the same. Okay? The question is, are you being trained in the standard in which everybody is operating? If you're not going to get there. If you are, you're going to get there because you understand. Okay? All right, so I'm almost pooping out here. God, this is a long class. And I talk too much too. Okay, so let's kind of go through it. So there's the stock reports. I'll give you a bunch of them, take pictures of it. I'll bring them back in class because it's full disclosure for me. I want you to see what the product looks like. I want you guessing. There's no tricks in this class because I need to train you as soon as possible. I got to get you to that level, and it's going to take a couple years. If you want to go back and look at some of the course videos, I record all of my videos so you can kind of get an idea of my style. My style is like in-your-face style. You know, I'm like, let's do it, let's get it done, let's work together, let's produce the product. There's 3 exams. The quiz that I gave you is the most intensive, okay? It's going to take the longest, and then the midterm is going to be a little bit shorter. It's going to be more reading, and then filling in the blanks, and then the last one is like super short, filling in the blanks. So you're at least going through the content, and you're learning the stuff that's really important. And I went through the book and I pulled out all the stuff that I thought was important, and the other stuff was okay. Let's see, syllabus, course description, all this stuff is already in it. I am available, not 24 hours a day, but if you want to get a hold of me, you want to talk to me, you want to ask me a question, what's the best thing to do?
Email me.
Really? Yes. You call me. Boom. I'll call you right back. You text me, I'll get right back to you. Email me, you get buried.
About 7 million.
Huh?
About 7 million. Yeah, like you're gonna do.
Oh, that's cute. Save it. I mean, send me a card or something. Yeah. But no, call me, text me. Email me, it's too much. It's too much management. I'll get right back to you. Okay. And then you got my phone number, you got the class schedule, and totally lay it out, in the syllabus. Do not get neurotic. Students are like, well, Professor Susan said he was going to do it on this day, and we had to delay it 2 weeks. It's like, I'm not moving forward until everybody's moving forward. I'm not leaving anybody behind. Okay? And if we need an extra week and I need to work with you guys another week, I don't care because I need to get all of you at the level. Okay? So the syllabus is a guide. It's not, etched in stone. Grading policy is pretty straightforward. You produce the deliverable package at a very high quality with your teams. You're working collaboratively, but you're producing the deliverables individually at a very high level. You're good. You're good to go. Okay. The textbook, Bodhi King and Marcus, which is basically the Bible. Okay, it's a good book. I developed some of the models in the class off of the Bodhi King and Marcus. It's the best book. I think it's the best book out there for investments. Is it the best book? No, you got to bring an application to make the book relevant. Okay, the book's just a book. But the question is, can you apply certain aspects of the book to actually generate revenue and create a business model around it? That's important. writing resources and guidelines. You guys have a writing center here, don't you? Don't you? All of your writing should go through the writing center. Okay? I will check your work, I will help edit your work, I will train you in the writing style of corporate level. Business writing is totally different from the writing that we do. We're very quick, we're succinct, to the point, punctuation is perfect, our grammar is perfect, there's no errors in it, it's very get to the point. And tell me what I need to do and move on. There's some review courses in here. Financial statement analysis, macro, micro, finance, econometrics, all that's in there, all the videos I compiled. You want to get your SIE, get your SIE right now. You want to get your SIE, which is the precursor to Series 7, which is the securities license that you need to basically sell and manage portfolios of securities. If you want to do that, I'll set you up and get you that. It's like $110. Okay. To do the SIE, I have AXA Insurance right here. They've sponsored me to basically provide the SIE to you if you want to do it. Do it. Okay. Series 7, Series 66, 63, or 65. That's all from FINRA. That's licensing. You can't advise anybody as an investment advisor without the 63, 65, or 66. Okay. And I would get the 66 because it trumps all the other ones. Okay. I can sell my research for a fee. With the 66, I can manage portfolios, charge a management fee. If I sell securities or trade derivatives on behalf, I can charge commissions. Okay. The real estate license, state of California, interested in that? Get it. I can show you how to get it, how to get it within the next 4 months. You get the real estate license, you can go work for a commercial broker, asset management, acquisitions, mortgage. If you have the license, you're in. You don't have the license, you're going to have to compete against others. The California State Insurance License. Well, if I have the Series 7, I have 66, what you got. If I have the insurance license, the variable annuity license, and the long-term care continuing education, I can solve any estate plan. I can solve any problem. I can do the risk management with all the annuity and the insurance products, and I can do all the investment product side too, with all of those licenses. I can solve anything. And then if I have a problem on the tax or the trust side, I bring in the tax and the trust, CPAs and the lawyers to basically solve the problem from that standpoint. Can't advise my clients on tax and trust law because I'm not an attorney. You want to do tax and trust law and that type of stuff, you're going to need to pass the bar, go to law school, take the LSE. If you want to do the accounting or the tax side, you need the accounting degree, you need the number of credits, you need to pass the CPA. You want to sign off on research, do equity research, you want to do portfolio management, you got to get the CFA. Okay. CFA, CPA, MBA, good school. You're now going to investment banking, private equity, or something trading, or whatever you want to do. There's a road, there's a map, there's a path. Okay, you can get to it, but they've already set it out. You know what the requirements are. You know what the requirements are. You know you want it. Then you're going to have to sacrifice to get it. Okay, no more party time because you got to get straight A's, basically get the GPA, and then ace the GMAT to get into the best school with 5 to 7 years of experience to go to the best school because they only recruit from the best schools. Okay. Or you're going to have to do what I did and basically get years of experience, get all these credentials, education, and try to get there. Okay. There's a path, quick path, and then there's a long path. Important movies, videos, Inside Job. Okay, I'm going to give you a movie review worksheet, and you're going to watch the movie and you're going to fill it out. Inside Job, Charles Ferguson lays out the whole corruption behind the financial crisis and the corruption that continues today in our field. Okay, and then The Big Short, right, which is really fun. It's what Brad Pitt and who's the other guy? Remember that movie? Christian Bale, exactly. Yeah, that one's really fun. And then you can pick another movie that you want, so you'll do 3. It's got to be around finance and stuff like that. Okay? Dynamic yield curve, lectures, intrinsic valuation, lectures, political, economic applications. A lot of my research is in policy, political policy formation, and the impact of politics and policy on investments. Do you think the impeachment is going to impact on asset values, yes or no? Yeah. So if you throw out the president, you bring in Bernie Sanders or some of the other more centrist type of politicians and executives, they'll probably impose higher taxes on more wealthier individuals and corporations, which could have an impact and a redistribution or reallocation of resources and investment flows. And there'll be winners and losers. Like there have been winners and losers under different administrations and different leaderships. Because they're wielding $22 trillion economy. They could, through policy, they could pick the winners and losers through policy. And that's the way it's been for decades. People just don't really understand it. Financial product innovation, there's a couple other that I'm going to do. Career planning. If you want career planning advice, I will give you career planning advice. I will point you in the direction. I will try to help you find a job. Because that's my success, right? Your success is my success. I'm investing my human capital and my human equity into you. And then you go off and be successful. Somebody goes, hey, where did you learn all this? I learned it from Professor Sousa at USM. Oh yeah, I know Professor Sousa, he was great. As opposed to, oh, he was the lousiest professor I ever had. Right? So the network is really small. Right? So if you invest in other people and treat other people with respect and be a good person, you're going to go so much further. But you got to build those relationships and know how to do the networking. So there's the pre-test resources up there. There's a whole bunch of manuals in there that will help you be able to answer the pre-test. Memo review videos. Again, more videos in there. Student examples, some examples of articles that you want to use for your memos. Solutions to the homeworks. I don't know, my philosophy is I can give you a bunch of homework problems and you can agonize over the problems, trying to figure it out, and it takes hours and hours to figure it out. Where I'm saying, here are the problems that are really important to know. Here are the solutions on how to solve them. Basically study the problem, write out the solution so you're memorizing how to do it the correct way, not the wrong way, by guessing. If you learn how to do it the right way, you're going to remember it forever. When you take the Series 7, the 66, the bar exam, the SAT, the GMAT, when you take all of those exams, you're going to be studying questions, answers, and you basically memorize thousands of questions and answers. So when you walk into the exam, you know all the right answers on the exam. Because you studied the questions and the answers correctly. Not trying to figure it out and solving it wrong and then having to go back and correct it and remember it. But looking at studying the problem and learning how to solve it the correct way the first time. Okay, so it becomes extremely efficient. If you're interested, I took all of the Excel spreadsheets that were provided by the book and put them up there. I would download them so that you have them available to you as a library. Okay, Excel-based resources. So you can understand how to do a lot of the modeling, but also if anybody asks you to do something, you might have an Excel template already developed, which is going to save yourself a lot of time. Okay. Technical analysis resources in this class, because now that you're in teams, before you come back next week, what you're going to need to do is you're going to have to tell me who your portfolio manager is, who's going to be the lead on it. And then you're going to have to pick a fundamental securities analyst, okay, who's going to do the fundamental securities analysis. And then you're going to have to pick a technical analyst who's going to be the technician that's going to be conducting the technical analysis. Okay? And then you all work basically together as a team. Okay? And then you're going to do all the research. Take-home exam, all PowerPoint presentations are there. What you're going to do too is I'm going to basically assign you the chapters within the book. And what you're going to do is I'll give you a week. Basically study the PowerPoint presentation, edit it down into a 10-minute presentation, and come in and do it in 8 to 10 minutes. Because that forces you to learn it. Okay? Because if I don't do that, if I don't do the exams the way I do it, and I don't have you do the presentations in the book, you won't do it. Okay? And I've got to teach the class on 2 levels: application and theory. Okay? So I teach it on 2 levels. What else do I have up here? PowerPoints, solutions, intrinsic valuations, videos, examples of intrinsic valuations. We do Wells Fargo, Bank of America, but we've been focusing mainly on JP Morgan and Goldman Sachs, okay, which are 2 of probably the best banks out of the peer group. Some examples of some student presentation videos. Anybody got a problem with me videotaping you and then making it available? What I can do is I can make it private, shoot it in YouTube, and make it private so that only you guys have access to it, so it's not public. Is that cool? You guys into that? You got to tell me if you're not, because then I won't videotape you. Some people don't want to be videotaped. The videotape is really good because as you do the presentations, what I do every week is I will upload the videotapes and I will push out the lecture content to you to allow you to go back and review it at some point in time. Because you're not going to get everything the first time. But by having the resource to go back and rewatch the video again, because there may have been concepts that you missed, but you can go back and review it, I think is critically important. I think all classes should be videotaped. Okay. But it'll probably not happen. Okay. Student presentations. And that's pretty much it. What I would do is get your student view to look like this view, so it's organized like this. So you're not digging around looking for something. So my communication channels that I use to distribute and push the content out to you is the website, is the main page, that's the knowledge base. And then I will push out the videos and content to you via announcements or emails. So I'm pushing stuff to you. And then if I email or send out announcements, you need to read it. Okay? I know you guys don't read the emails and read the announcements. You need to read it. Okay? So email, text, calls, maybe emails personally, but I'm going to be pushing content out to you, the main page, and then one-on-one and team interaction. Okay, will be the communication flow and the communication. Okay. I think that's it. What time is it? Perfect. We're out of here.
I believe it's in
That's fine.
And start on the pretest.
So for next, okay, start on the pretest, for next class, this homework test.
I just assigned it. It's just assigned.
I'm gonna give it.
It's assigned.
Okay,
It's not due.
okay.
It's going to be due in like 4 weeks.
Okay.
Well, and I need all the reports back.
And then I'm just gonna do the presentation next week.
No. What I'll do is I'll assign the teams to the different chapters.
Okay. I'm gonna be here every class, but I have
Yeah, but don't worry about it. Don't worry about it. If you're not ready, then
Oh, no, I won't be here.
that's fine. Yeah, that's fine. I appreciate it.
Yeah. So I'll shoot you a text to remind you.
Okay. Yeah, I appreciate it.